The numbers coming out of Washington say the nightmare is over. According to the Bureau of Labor Statistics, grocery inflation in America has cooled to a modest 2.7%. Press secretaries quote it, financial anchors celebrate it. On paper, the economic firestorm that gutted household budgets for 4 straight years has officially been brought under control. Yet, if you walk into a grocery store in Ohio, Texas, or California today, the atmosphere feels less like a celebrated economic recovery and more like a quiet, slow-motion crime scene. A woman in her early 30s stands outside an Aldi in the Midwest. She holds a college degree, works a full-time 40-hour-a-week job, and just drained half her remaining savings to survive until Friday. Her bank balance sits at exactly $85.26. That number has to cover 2 full weeks of groceries, fuel, and unforeseen emergencies before her next paycheck arrives. She isn't an outlier. A few aisles over, a shopper puts back a basic jar of peanut butter because her remaining $9 cannot cover both the spread and the bread. Across town, another shopper spends $78 on ingredients for 2 basic home-cooked meals, stares at the itemized paper receipt, and realizes with chilling clarity that taking her family to a sit-down restaurant would have cost roughly the exact same amount. This is the central paradox of the modern American economy. The official metric says inflation is slowing down, yet the human experience at the checkout counter has reached an absolute breaking point. To understand why this disconnect exists, you have to realize a fundamental truth about how economic data is manufactured. Slower inflation does not mean lower prices. It simply means the rate of the increase has decelerated. Imagine a 2-ton freight train accelerating down a mountain. If the train accelerates at 40 miles per hour in year 1, 30 miles per hour in year 2, and only 5 miles per hour in year 3, the train is still moving faster than it ever has in human history. It hasn't pulled the brakes, it hasn't reversed course, it is merely barreling toward the edge of the cliff at a slightly less terrifying acceleration. When the government announces that food-at-home inflation is running at 2.7%, they are layering that percentage on top of a baseline that expanded by 30 to 40% over the preceding 36 months. The $100 cart from 2020 became a $135 cart in 2023, and today's slow inflation simply nudges that cart to $140. The cushion that once allowed the average working family to absorb an unexpectedly expensive week, a sudden price hike on milk, a spike in meat, a missing discount, has been completely incinerated. What we are witnessing is not a temporary statistical blip. It is a fundamental rewriting of the rules of survival for the American middle class. For generations, the supermarket was the one reliable sanctuary in American life. You paid your rent, you paid your mortgage, you paid your car loan, and whatever was left over went to the grocery store, where a $20 bill could still buy a mountain of staples. Today, the supermarket has transformed into the primary arena where every single pressure point of the global economy collides at once. Rent increases, surging credit card debt, sky-high auto insurance, and stagnant wages all condense into one brutal, unavoidable moment when the barcode scanner beeps dot. And yet, the official narrative insists the system is functioning normally. The government measures a broad, abstract basket of goods designed to represent a theoretical average citizen who does not actually exist. But real human beings do not eat national averages. They buy specific items, at specific stores, in specific zip codes, under specific constraints. And when you crack open that national basket, you discover a horrifying reality. The basic staples that low- and middle-income families rely on to survive are skyrocketing at rates that defy headline statistics, while luxury items and volatile commodities mask the true damage underneath. Why is ground beef, the historic anchor of affordable family dinners, approaching $8 a pound? Why are fresh vegetables seeing 30% price surges, while overall inflation claims to be under 3%? And more importantly, why does recreating the exact same grocery order from 12 months ago reveal a 44% jump in total cost, while official reports insist everything is fine? There is a sinister structural mechanism at work here, a trap built out of collapsing cattle herds, concentrated corporate oligopolies, aggressive algorithmic pricing, and a crushing dynamic where cooking basic food at home is losing its historic cost advantage over fast food. What is happening inside the American grocery aisle is not just an inconvenience. It is a structural crisis that is quietly forcing millions of fully employed citizens into measurable food hardship, while the metrics tell them they have never had it better. To understand how the American supermarket turned into a financial pressure cooker, you have to track the structural shifts that began long before the recent inflationary spike. The current pricing environment is not an accidental mystery. It is the direct mathematical result of long-term policy decisions, historical supply contractions, corporate consolidation, and geographic realities that have quietly reshaped the agricultural landscape over the past 2 decades. The most visible casualty of this structural breakdown sits in the fresh meat counter. For decades, ground beef served as the foundational protein for working-class budgets. It was the flexible item that could stretch across multiple meals. Today, beef and veal prices have surged by 11.8% year over year, with federal projections estimating sustained elevated levels above 10%. In retail locations across the country, basic ground beef frequently touches $8 per pound, while premium cuts exceed $22 per pound. This price spike is rooted in a severe, long-term geographic contraction. The United States cattle herd has officially dropped to its lowest level in 75 years. A severe multi-year drought across the southern plains and western grazing lands destroyed pasture conditions, forcing ranchers to liquidate breeding herds because the cost of feed and water exceeded prospective returns. Rebuilding a cattle herd is not a rapid operational shift. Unlike poultry, which operates on a weeks-long production cycle, or pork, which takes months, beef production requires years. A rancher must decide to retain young heifers, raise them to maturity, breed them, and wait through a 9-month gestation period before a calf is even born. That calf then requires up to 2 years to reach market weight. As a result, the supply shock currently hitting slaughterhouses, processors, and retail display cases was baked into the system years ago. While supply contracted, processor consolidation accelerated. Today, 4 major meatpacking conglomerates control over 80% of the domestic beef processing capacity in the United States. When processing infrastructure is concentrated in so few hands, any localized bottleneck, labor dispute, or corporate pricing strategy multiplies instantly across the national supply chain. Ranchers face depressed livestock purchasing prices at the farm gate, while retail consumers face record-high prices at the checkout register. The wide margin between the farm value and the shelf price remains captured by the intermediate processing and distribution layers. The agricultural dollar data published by the Department of Agriculture exposes where the consumer's money actually goes. Out of every dollar spent on food consumed at home, American agricultural producers receive only 18.5 cents. The remaining 81.5 cents belongs to the marketing share. This massive segment covers commercial processing, specialized packaging, long-haul transportation, wholesaling, retail operations, and corporate profit margins. When energy costs, diesel fuel prices, commercial refrigeration electricity rates, and warehouse labor costs rise, that 81.5 cent share expands rapidly, entirely independent of raw farm output values. This systemic expansion explains why specific grocery categories are moving in wildly divergent directions, completely dismantling the concept of a single headline inflation rate. While federal data shows egg prices dropping 27.9% following recovery from avian influenza outbreaks, and poultry prices easing slightly, basic plant produce and grocery staples have diverged drastically. Over the same 12-month tracking period, fresh lettuce prices escalated by 32.1%. Fresh tomatoes rose 19.5%. Sugar and sweet products increased by 6.9%. The divergence reveals a geographic trap built directly into the American food distribution network. A massive percentage of fresh produce consumed in the United States relies on concentrated growing regions in California's Central Valley and localized international imports crossing southern border checkpoints. Water allocation restrictions, surging agricultural labor wages, increased freight transport tariffs, and unpredictable climate patterns in these primary growing corridors create instant price shocks. When a household attempts to purchase basic ingredients for a salad or a fresh meal, they encounter compounding price shocks that are entirely absent from processed grain or poultry metrics. The result is a complete breakdown of historical consumer behavior. Historically, when prices on one commodity rose, consumers seamlessly substituted a cheaper alternative within the same category. If beef grew expensive, households bought chicken or pork. If fresh vegetables spiked, they bought frozen or canned alternatives. But current market dynamics have restricted those safety valves. When rent burdens, transportation costs, utility bills, and consumer credit repayments consume 60 to 70% of a household's take-home pay, the absolute margin available for food purchases shrinks to a critical threshold. Under these compressed conditions, even minor percentage increases across secondary food categories eliminate the ability to absorb cost swings through traditional product substitution. The collision between macroeconomic statistics and daily financial reality reaches its peak inside individual shopping carts across the nation. While official index calculations blend thousands of products into a smooth average, the real-world mechanics of modern grocery retail present a far more hostile environment for the working class. The friction point is no longer just high prices, but the aggressive volatility and hidden costs embedded within the supply chain. A detailed look at real consumer transactions illustrates the profound gap between published inflation figures and personal experiences. In one tracked instance, a consumer recreated an exact online grocery order from Sprouts originally placed in July 2025. The original order, consisting of 21 everyday pantry and fresh items, totaled $135.66. When reloaded into the cart at the exact same store location 12 months later, the identical basket reached $196.00. That reflects a nominal surge of over 44% on a single routine grocery run. While economists point out that individual store promotions, expiring regional discounts, seasonal supply shifts, and platform service fees skew one-off comparisons, these technical distinctions matter very little to the household budget. Families do not purchase theoretical, index-weighted aggregates. They purchase specific, repeating sets of goods. When multiple core items simultaneously lose promotional pricing or suffer localized price spikes, an individual family's personal inflation rate far outpaces the federal government's reported 2.7% average. This environment has triggered a structural breakdown in a traditional economic safety assumption that cooking at home is always significantly cheaper than buying prepared food. Modern grocery receipts tell a much more complex story. Ingredients for two basic meals, such as fresh protein, vegetables, seasonings, and dairy, frequently total between $70 and $90 at checkout. When factoring in the hidden costs of food waste, preparation time, and residential utility usage, the historical cost advantage of home cooking has eroded sharply. Simultaneously, the fast food industry has implemented its own aggressive price increases, with standard orders at major chains routinely reaching $15 to $20 per person. Food away from home increased by 3.4% over the past year, continuing a multi-year trend that has priced many low-income families out of both options. The consumer is trapped between an expensive grocery aisle that requires labor and cash up front, and a fast food sector that has stripped away its historical budget appeal. This squeeze is exposed most clearly when analyzing household balance sheets. According to data from the Federal Reserve, 91% of American adults cite higher prices as a persistent financial concern. More critically, only 63% of adults report being able to cover an unexpected $400 expense using cash or an immediately payable credit line. The remaining 37% must borrow, sell possessions, or simply default. The pressure on the grocery budget is the direct result of non-discretionary fixed costs exploding elsewhere. Over 23% of renters nationwide report falling behind on lease payments, while average credit card balances among financially stressed households have surged by more than 35% since 2023. Because rent, car loans, health insurance, and debt service are fixed, contractual obligations that cannot be renegotiated at will, the supermarket receipt becomes the final variable expense that gets squeezed. Federal research indicates that 13.7% of American households, representing roughly 18.3 million families, currently experience food insecurity, defined as having limited or uncertain access to adequate food due to insufficient financial resources. Even more severe, 5.4% of households, or 7.2 million families, suffer from very low food security, meaning members actively skip meals or reduce food intake because they simply cannot afford the register total. The friction is further amplified by geographic and structural inequalities. High-income households with private vehicles can mitigate costs by cross-shopping between discount chains, bulk wholesalers, and regional supermarkets to exploit unit price savings. Conversely, low-income shoppers, single parents, elderly individuals on fixed pensions, and residents of transit-starved urban or rural deserts lack these operational choices. They are tethered to localized corner stores or single neighborhood markets, where markups are highest, unit sizes are smallest, and bulk discounts are non-existent. For these households, the modern grocery trip is no longer a routine errand,